I'm going to begin the recording here. So that is going, and let me share my screen. All right, so how is everybody today? Hopefully you can see my screen and, less importantly, see me. Hi, I'm in my office and hear me. I guess that's important. As previously, I'll mention that if you have a question today, it's best if you go ahead and use your microphone to ask the question. The audio alert that Blackboard Collaborate gives for a typed question is so subtle that most likely I'll miss that if you type a question. And of course, if I don't miss it, I'll address that as I can, but it's best if you just go ahead and interject with your spoken question if and when you have one. All right, so today we're going to go over a couple of announcements before we continue with the material. The first announcement I want to share with you is that hold on a second, there we go. All right, homework 0, I've already gotten plenty of calls through Microsoft Teams related to homework 0. Remember, that's the one where sometime before 2 p.m. on Friday, you're going to give me a call and we're just going to chat briefly on Teams. And the purpose of that is twofold. Number one, it gives us a chance to connect with each other and make this a little bit less impersonal. I get to know you a little bit better, and you get a sense for that there is an actual instructor out there who cares about you and is interested in helping you learn this semester. So, the call between us is partly about that, and then it's also just so that you can figure out the technology behind placing a Microsoft Teams call. Just as a refresher, let me show you. Now, I think that the student view of Teams could conceivably be a bit different than the instructor view of Teams, but the best way to initiate that call with me on Teams is, I'm just waiting for it to load up here. All right, I'm going to drag this over so you can see it. If we go here to the calendar, so if you click on calendar and then click on meet now, so you say you're going to have a meeting and then you click on join, and then now, I'm not sure. Well, let's give it a try. Join now. And then over here up at the top right, you type in the name. So in my case, you're going to do @wait, and it'll find me. But, like if I was going to call Dr. Michelson, I'd say Michelson. And there it finds him. So as soon as I click on it, it's going to initiate a call to him. So that's just one of many different ways that you can initiate a call on Teams. But when I'm not setting up an appointment, when I'm just calling someone directly, that's the best way to do it. Okay, so let's talk about Teams, a video chat, an audio chat. Let's do it before 2 p.m. on Friday, and then that gives you 10 bonus points that go towards homework. Homework number 1, which is some calculation stuff, that's available now on Blackboard. It's due by Wednesday of next week, and you need to upload a single PDF file. So don't upload JPEG files. Don't paste pictures into a Microsoft Word document. It should be a single PDF file. So not individual PDF files. It should be joined together as a single PDF. And black and white is the best for that, for the improved image quality. So Cam Scanner is one good option. You can use a flatbed. Adobe has a scanning app that uses mobile phones, and so that's the way to do it. Okay, I also wanted to point out a couple of new things on our class page, so let me bring that up for you to see here in Blackboard. Here's our class page, and so you've already found this link. That's where we are right now, Collaborate Ultra. In the homework assignments is where you're going to be able to find the first real homework assignment where you're crunching the numbers. And so if you click on homework 1, then it brings up the PDF. And I suggest that you save a local copy of this PDF. And the reason why I mention that is that when this assignment closes, you won't be able to access this PDF any longer. And so if you save a copy of this PDF file on your hard drive, then when you're preparing for the midterm exams, then you'll have not only your solution on paper, but also the original question. So save that PDF file locally. The way that you do that here is you'd like click this Save Download button, and then there it goes. You can choose the location for it. Okay, so that's the homework, and if you actually are ready to submit the homework, if you click on Homework 1, this link here, as you click on that, then I see some chats going on here. Oh. Why don't you try talking again? Was there a question, James? Did you have a question earlier? Try now.
I think I was the one who had a question.
Yeah, I hear some questions now. Go ahead.
I just wanted to know if you wanted us to email you and schedule that meeting ahead of time, or just call you during your office hours.
Yeah, great question. Just go ahead and call me during my office hours. And outside of my office hours, you can go ahead and call me then too. It's, outside of my office hours, I may not be able to pick up if I'm in another meeting or away from the office. But if it's during my office hours, I'll be able to pick up unless I'm currently talking to another student, in which case I'll have to reject your call. I'll write down that you tried to call me, and then I'll phone you back. But yeah, don't schedule the appointment with me. Just go ahead and call. Does that answer your question?
It absolutely does.
All right, thanks. And sorry I didn't hear you earlier. Was there any other questions that I missed? Okay, so as I was mentioning, how do you submit this first homework assignment? You're going to have a PDF of it. So you're going to go to Browse My Computer, and you will, that's odd, you'll do this Browse My Computer and upload the file, check it, and then submit. Okay, so that's one of the things I wanted to point out here in our course, is that in the homework assignments, you can see homework number 1. I'm going to try and load up more of the homework assignments. I don't know if I'll be able to do the entire semester all at once, but I'm going to load them far enough in advance that if you're an early bird, you'll always be able to get started on the homework assignment that you've seen some material related to. In the previous lecture, I already pointed out the lecture notes and how you can print those in a variety of different formats. I've added in the in-class exercises all of them for the entire fall semester. And so, 1 and 2 is individually, but if you open up this one for the entire semester, you can print those out now wherever you are able to print stuff off. And it would be a good idea when you do print it, if it's an option, wherever you're going, like get the 3-hole punch automatically into it, if you're going to a print shop or something, but maybe you have your own 3-hole punch so that you can put it into your 3-ring binder. So these are, for the entire semester, the in-class exercises that we're going to go through. So you'll notice that they're numbered according to the same numbering system that our lectures follow. So today is lecture 2. So we're going to go through, in today's lecture, we're going to go through, wait for it, there it is, in-class exercise number 2. So if you have these all printed out in advance, then we go through it in the class meeting itself, and you'll have the space you need to solve it, and it's going to look familiar when I show you the solution up on the screen. And it goes through the entire semester, including, we get through 41 class meetings by the end of our semester, and so there's in-class exercise 41 right at the very end. On days of exams, there isn't an in-class exercise, and so, for example, if you look through this list, you won't find an in-class exercise number 16. There's not an exercise number 29 because we have exams on both of those days. All right, so that's newly added since the last time that we met, those in-class exercises. And this project folder right now is empty, but I'm going to give you the PDF file for the project when it's assigned. That's the day after our first midterm exam, is where you'll have enough under your belt that you can start getting into the project-related stuff. Okay, so any questions related to this content that's in our Blackboard for the course? Okay, so the format for our class is that we will hit this announcement slide at the beginning of the class meetings just to try and keep you on track with what's going on and informed about deadlines and so on. It usually won't take us this long to get through it. Here we are at 12 minutes into the class meeting, but we're still just kind of getting our sea legs, and there's a lot more announcements than usual because of that. All right, terminology. Let's talk about money. We finished our last class meeting by looking at in-class exercise number 1 that had a table that illustrated some savings accounts rates. And let me bring up the solution to that because we kind of did go through that a little bit quickly. This table of interest rates, and so I'm bringing it on the screen now. In class on Monday, we were talking about why are there different interest rates for different types of accounts. And so in this in-class exercise, we had a hypothetical savings account that's paying 1.65% compared to 2% for a CD. Well, a certificate of deposit is where you are promising to the bank that you're depositing the money to that you're going to leave the money in the bank for a certain amount of time. And so with the CD, that gives that institution a little bit more flexibility on how they use your money if you promise that you're not going to come back tomorrow and take it back out again. Because in the case of a savings account, if you're giving it to the bank, the way that they make money with your money is they loan it out to someone else. They're going to take the money you give them and they're going to turn around and loan it to somebody for a house or for a car or maybe for purchases with a credit card. And so they're putting your money to use with other people. But if you come back the very next day and you want your money back, they may not be able to give it to you because it's already tied up in a home loan or an auto loan or with credit card purchases. And so in order for them to have a little bit more stability in their system, they try and offer an incentive for you to deposit your money for a fixed term. And so a certificate of deposit could have a 1-year duration, a 2-year duration, a 5. And generally the pattern is that the longer you leave your deposit with the institution, the higher the interest rate is going to be that they offer you. All right, so in the
case, do they provide any guarantees that you were going to get your money back at the time that's agreed upon? And if they can't make good on that, then what happens?
That's a great question. Thank you for asking that. Banks in the United States are FDIC insured, and the FDIC is the Federal Deposit Insurance Corporation, and it's backed by the full faith and credit of the U.S. government, which doesn't sound like a lot. We joke around about how incompetent our government is and how, Congress is not getting a lot accomplished, but the United States government has never defaulted on its debts. And so it's considered in the world the best investment you can make is an investment that's guaranteed by the U.S. government. And so like if the bank that you have deposited with goes bankrupt, you don't lose your deposit. It's federally insured. And there are limits to how much the federal insurance will cover. I think that for a single account, the insurance limit is $250,000. And so if you put your money into a bank and you say, I want a 5-year CD, they guarantee that they'll pay a fixed rate during that term. You promise to leave it in there for that term. And if you withdraw it early, they will let you take your money, but then there's a penalty. But if the bank goes bankrupt, there's no need to panic. Like if you've watched any old movies, like what's that Christmas movie with Jimmy Stewart where there's a run on the banks? I forget the name of it, but in any case, that was an old trope that people would have a run on the bank because they're worried the bank is going to go under and there was so much uncertainty and financial panic. We don't have that nowadays because of FDIC insurance. Are there other questions related to this table or any of the things that I've been mentioning so far? I like it. If you've got a question, please jump in. It makes this whole experience more interesting for all of us if it's a two-way street. Okay, so a checking account is the sort of account you'd use if you're going to be making frequent withdrawals and deposits. A savings account will pay interest, whereas checking accounts typically either pay no interest or so little that it's insulting. I have an interest-bearing checking account that offers 0.01%, and It's just silly that they even call that an interest-bearing checking account. In the case of a savings account, there are usually limits that the bank imposes on how many withdrawals you can make in a month, and you typically can't write checks against a savings account either. And from the perspective of the bank, they can change the interest rates at any time on a savings account because they're not promising deposits of a fixed term. A money market account is kind of a hybrid between a checking and a savings account. Money market accounts, you often can write checks against a money market account, and it has interest that's actually worth earning. And in some cases, the interest of a money market account is even higher than the savings account with the same institution. And then we've already talked about a CD. Sometimes people will pull out a piece of plastic from their wallet and be confused about how it's different from another piece of plastic. I guess maybe I better not show you my cards because then you get the number. I'll show you one of them. So here's a credit card I've got that's different from a debit card. You know, they're the same shape. They both have a chip on them. And so from appearances, they're identical. You can buy things with both a debit card and a credit card, but they're different in important ways. A debit card is linked to your checking account so that when you spend money on a debit card, it's coming out of your checking account balance immediately. A credit card, by contrast, when you spend money, you're actually spending the bank's money and you're promising to pay it back, but you've usually got a month of, they call it float. You know, it's the period of time between you make a purchase and when you have to pay back the money without interest beginning to become incurred. If you pay your credit card bill every month, then you don't have to pay interest. So credit cards can be really dangerous if you start spending money that isn't yours and you don't have to pay for it until the future. And what can be especially dangerous is that the credit card companies have the incentive for you to pay the minimum payment because they want you to just pay a little bit every month so that the interest begins to accumulate. And, you know, going back to a typical interest rate on a credit card, from our in-class exercise, this 23.99%, that may seem so big that it seems like maybe a typo or an exaggeration, but no, that's a typical credit card interest rate. And so it's shockingly high. On an annual basis, borrowing money from the bank on a credit card can really get you into trouble really quickly. And so just a little bit of life advice. If you do use a credit card, pay it off in full every month. You should not be financing the sorts of things that you buy with a credit card. You know, maybe it's okay to go into debt to buy a house and to get an education and maybe to buy a car, although, you know, just buy a cheaper car so you don't have to go into debt. That's been the approach that I always follow. But you absolutely should not be financing the sorts of things that you buy with a credit card, like today's lunch or a pair of shoes. All right, so I'll get down off my soapbox, but just too many people get into trouble and then regret the power that the credit card has over them. Mortgage loan is purchasing a home or land, so you're securing the purchase with a promise to the bank that if you don't pay them back, they can repossess the item from you. And so the amounts are high enough that ordinarily a mortgage loan would have a term of 30 years. In some cases, people will have shorter terms. A 15-year term can be a little bit more common in some cases, not more common than 30, but you will see a 15-year term out there. The interest rates are lower for a 15-year term because there's less interest rate risk. And I touched on that briefly in our last class meeting. Interest rate risk is the risk that interest rates will go up, and then if a bank has loaned you money for 4%, and then interest rates throughout the country go up to 6%, then it's kind of like they have lost out on the opportunity to loan money to someone else at the higher rate because you got it for 4 and they could have loaned it to someone else for 6. And so that interest rate risk is why banks want to charge more for a longer duration loan. So that's an important concept to understand. A home equity loan is where you are borrowing against the value of your house that you own. So if you are purchasing a home and it's worth $200,000 and you still own the bank, let's say you still owe the bank $50,000. So you own, of that $200,000 house, 150 of it is yours and 50 of it is the bank's. And so you can take a loan against your equity. So the equity is how much of the home's value you own instead of the bank. And so sometimes people will use that equity as the basis for a loan to make home improvements or to pay off medical bills or finance college tuition and so on. So that's
I had
another.
a question.
Go ahead, Josie.
What's the benefits of doing a home equity loan and loan?
So the benefits of a
Why
home
do people
equity
choose
loan,
that?
you cut out a little bit, but you're just asking why would someone use a home equity loan instead of something else?
Yeah.
That's a great question. If you look at the interest rates for home equity loan, a typical interest rate would maybe be 6%. Now, compared to a credit card where the interest rate's 24%, if you had a bunch of credit card loans out there that you're paying every month 24% annual interest on, it would be better to consolidate all of those loans and put it into a home equity loan because you'd be ending up paying less interest. And so since the home equity loan is secured, the interest rate is lower because there's less risk to the bank. In the case of a credit card, that's unsecured. They don't have any collateral that they can go repossess if someone fails to pay. And so a home equity loan has a lower interest rate than a credit card would. And so that's kind of why sometimes people would finance home improvements with a home equity loan, is if you're going to go buy lumber and siding and roofing, a lot of things that otherwise you were going to put onto a credit card and pay a higher interest rate, then it's just more advantageous to get the lower interest rate associated with the home equity loan.
But does that not put more risk on the person taking out the home equity loan? Because if you default on that loan, then you lose your house, right?
That's right. Yeah. So it gives you more risk. That's right. But remember, you're paying less interest because if you guarantee that you'll pay it back with the equity in your home, then it's not going to cost you as much to do that project, so to speak. Like the shingles and the roofing and the siding that would have cost you a lot more in interest payments before you got it paid off. So it's a trade-off. You are kind of threatening your equity though. So you should only take out loans if you're confident that you'll be able to repay them. You should never think of it as a risk at all. But the economy can fall apart and suddenly maybe what seemed like a steady career is a lot less sure. So I guess nothing's really certain. But you're absolutely right. If you default on a home equity loan, now the bank owns your house. So got to be cautious. Other questions related to this consumer finance stuff?
Earlier you talked about the U.S. had never defaulted on any of our loans. What does defaulting on a loan mean?
That means that when an interest payment is due, that the person who owes the interest can't pay it. And so the United States government sells bonds to investors. When the Treasury is trying to raise money, what they'll do is they'll sell bonds, and they do it through an auction. So what it is there's a variety of time horizons, but just as an illustration, let's say that the U.S. government is selling a 10-year bond. And what that means is that if you give the government $1 million, 10 years from now, they'll give back the $1 million. And until then, they're going to give you quarterly payments. Every 3 months, they'll give you interest. And so you get the repayment of the principal at the end of the loan and periodic interest. So if the U.S. government wasn't able to pay those, either the lump sum payment at the end or the periodic interest, then that would be considered a default. And there are other countries that have defaulted. The country Argentina is almost perpetually in default, it seems like, where they've taken out loans and they're not able to repay their loans, And so that puts them in default. And as a result, because it's a risky investment, countries that are a risk at default, they have a lot harder time raising money. Several years ago, Greece was having trouble raising money back in maybe like 2008 through 2012. They were going through a financial crisis in Greece where they had to offer like up to 25% interest in order to get people to loan them money because there was more risk of default. Whereas the United States, Japan, Germany are some of the countries that have the best credit record and can borrow money for almost free. You know, the United States government can borrow money for 1%. The German government sometimes can borrow it for even less. So that's what I mean by the default.
So what about secured credit cards? Are they the same as debit cards, or is it still like a credit card? It's just that you have to put money down on it first or something like that?
That's a great question. I think what you're talking about is a product that some institutions offer to people who either don't have a credit history or have like a credit history with problems in the past, like maybe they didn't pay on time. And so I think a secured credit card is kind of a hybrid between a debit and a credit card where, you know, you put $500 in this escrow account and then they'll allow you to maybe put up to $1,000 on it. And so it's kind of like a way for them to hedge the risk so that there's this money that they know they can get a pool of it. So it's kind of like maybe the collateral, so to speak. But I don't think that you could consider it a checking account. Great questions. I love that you're thinking about the material. Let's talk about this figure. This is one of the very important figures for this course. And what it illustrates is that when a company or a person borrows more and more money, that it's going to become increasingly expensive to borrow that money. And so that's what the trend is illustrating here. If you look at the horizontal axis, it says cumulative amount. And this is the cumulative amount that has been borrowed. And so if you think about if you went to your company went to a bank to try and borrow money, maybe the bank isn't that worried when you borrow $1 million. You'll notice it's 10% interest to borrow $1 million. And if you borrow $2 million, it's still about 10%. But then by the time you've cumulatively borrowed $3 million, they're starting to get a little bit nervous. And the reason why is that they're considering your ability to repay the loan. When a company goes to a lending institution, they have to take a portfolio of who their clients are, what accounts receivable do they have, what are the upcoming projects. So you're basically opening up the books to the bank so that they can inspect how your business is doing. And even if you have a really wonderful business, there's going to be some upper limit where the bank starts to get nervous and they perceive that there's a greater risk of default. And so the trend that I want to illustrate here is that as the amount that you've borrowed increases, the lending institution is experiencing more risk, and so they want a greater rate of return to compensate them for the greater risk. So interest rates are often related to how much risk it is. So here it is in text. It says that as the cumulative amount borrowed increases, then the risk of a borrower not being able to repay is going up. So since there's more risk, then the lender wants to earn a higher rate of return. Sometimes students make a mistake. I'll ask them to explain this figure, and they'll say, well, maybe it's because it's going to take longer to pay off the loan. And so that's not it. It's not about how long it's going to take to pay off the loan. This trend is independent of loan duration. This trend is all about risk of default. Not being able to pay is default. All right. So that's the story of that figure. Now we're going to jump into the in-class exercise for today. If you don't have it printed out already, then what you can do is you can just get a scratch piece of paper And the in-class exercise is going to be here on the screen. I'll show on the screen the first two problems. And I'm going to pause for a moment without giving you too much hint on how to use these equations. You know, we didn't specifically talk about these equations today, but sometimes what engineering and computer science is all about is self-directed learning and figuring things out with a little bit of a clue and a little bit of guidance. And so here on the screen, I've given you a formula, and I've given you some hints with the bold on what's P, what's F, what's N. So this formula is similar to what we were talking about in class on Monday when I gave you that formula where it describes interest amount, interest rate, and the principal. All right, so I'm going to pause for now and give you some time to figure out this clue. If you haven't printed out the in-class exercise, then just try solving this on a scratch piece of paper, and then in a moment or two, I'll bring up the solution and we'll talk through it together. All right, so you've never seen this formula before, but the first one, what it allows you to do is calculate a future amount based on a present value, an interest rate, and then the number of years of compounding. We haven't talked about compound interest yet directly, but this is kind of like a preview taste of the effect that occurs when you have to pay interest on top of interest. Okay, so P is 85,000. In this case, I is 9.5%. And so for the I, you don't put in 9.5, you use 0.095. So inside of the parentheses here, it's going to be 1.095 in the parentheses. And then, of course, N, the number of years between the future and now, is 3 years. And so let me bring the solution up on the screen there just to show you the end result. Scroll down here. All right. Oh, that's too big. Okay. All right, so here I've defined the variables. P, the present amount, is 85,000. I, the interest rate, we have to express it in terms of a decimal to put it into that parentheses. And then the future amount is what we're trying to find. And so that's $111,599.25. That's what you're going to owe in the future with the effect of compounding. And we'll go through the details of what I mean by compounding, but this is kind of like a sneak preview of how things go in the future. All right, the second question was asking, your uncle will loan you $3,500 if you repay him $4,250 after 4 years. What's the annual interest rate? All right, so what's the given and what's the unknown? Let's look at this formula here. So the excuse me, the loan of $3,500, that means today. It doesn't specifically say in the problem statement that the loan is today, but that is kind of implied. So P is $3,500. Now, if you repay him $4,250 after 4 years, so the $4,250 is the future amount. Now, let's just ask ourselves logically, does that make sense? Well, if your uncle is giving you $3,500, he's going to want more than $4,250 more than that in the future. So like it being $4,250, that's the future amount. Okay, so that's F, 3,500 is P, 4 years, so 4 is N. Now N doesn't always mean how many years, it means the number of compounding periods. And that's another issue that we'll get into the details of it in a future class, but I wanted to just point out now, the first time what we're using this equation, that oftentimes the interest is compounded on an annual basis, but sometimes it's compounded more frequently than that. Sometimes interest is compounded on a monthly basis, or even in some rare cases on a daily basis. But our problem is asking what's the annual interest rate. So N is 4 years, and then the I that we're going to solve for will be the annual interest rate. So I'm curious, did anybody successfully solved for that yet? All right, we've got some 4.97%. Okay, so Jeremy's asking the solution to the first problem. Let me switch back to that just to bring it up on the screen. Jeremy, can you see that? All right, now don't be shy to chime in with the audio. Don't be shy at all. There's 40. All right, good. So the second problem, all right, so we've defined the variables here. 3,500, 4,250, n equals 4. I is the unknown, so we're solving for the I. It's 4.97%. Now, I use a solver on my calculator, and the class that we're in right now, Engineering 222, most students will have taken this class 222 after they've taken Engineering 111. Not everyone, but most people would have taken 111. And during that Engineering 111, you're learning how to do like equation solving on the Casio calculator. I happen to use not a Casio, I use a Hewlett-Packard calculator because it's better. But in any case, one of the things that you may need to do occasionally this semester is to be able to solve equations. So solving for the variable I numerically on your calculator, that's one quick way to do it. And if you need some specific assistance on that, that's something I'd be glad to show you, like maybe during a Teams call or something, how to solve an equation for a variable. All right, so any questions before we move on from these first two problems? For in-class exercise number 2, just calculating interest amounts, calculating interest rates. All right. Draw a sketch, including labels, to summarize the following. Today you receive a $10,000 from the bank, and then starting 1 year from today, you make 4 annual payments to the bank in the amount of $3,300. Now, sometimes I'll give you like a concept question like this before we introduce the material, just because I want to see if you can figure out some way to illustrate it and then match it up with like the common convention for doing that. You know, there is a standardized approach that we take, and I'll tell you that approach, but I'm interested to know what you come up with. Maybe you'll kind of reinvent the same thing that's already been defined as the standard method for doing this. And so let me pause for a moment and have you sketch a cash flow diagram that summarizes what happens if you get money today and then you have to pay it back in the future. And I'll give you a hint. Time is linear. So if you draw a horizontal line that represents years, then the arrows could represent amounts. Okay, so let me leave it at that for a moment, and then we'll take a look at a couple of ways to summarize graphically and visually the two problems that are introduced here. All right, let's take a look at what approach we'd use to visualize and summarize this problem statement. Okay, so this shows the typical convention we use to graphically summarize problems like this. Today you receive $10,000, and so today is times 0. That's the first important thing that I want to point out, is that when we do a cash flow diagram like this, we will represent, what are you seeing right now on my screen? Are you seeing, okay, yeah, for a second there, okay. Can everybody see the solution to that cash flow diagram problem? Okay, good. If you get money, it's an arrow that's up above the line. If you have to pay money, it's arrow that's down below the line. So the way that we'd summarize that problem statement is that here in the present, we get $10,000 $10,000. So you're receiving it, it's an arrow up. And then starting 1 year from today, so at time 1, time 2, time 3, and 4, there's going to be 4 annual payments in the amount of $3,300. And so A, that letter A means that it's a recurring annual amount and that each year it's the same amount. So this is one approach that we can use to show financial arrangements in a way that doesn't require like a written problem statement. This graphical summary makes it very clear what's happening. It makes clear that you get $10,000 and then you have to make 4 payments of $3,300. So any question about this first sketch?
How do we show interest on that type of a sketch?
Good question. In the problem statement, it doesn't tell us what the interest rate is. And sometimes you'll have sketches where in the, like up here in this area, it would have defined I equals, and so it would define the applicable interest rate. But in this case, this is something where you'd have to maybe solve for the unknown interest rate. So what if you got $10,000 today and then you had to make these payments? And so the way that maybe you'd see a problem like this, it would be I equals, and then it would have a question mark. So it's unknown. This 3,300, what is 3,300 times 4? Let's just do that on a calculator real quick. 3,300 times 4, so it's 13,200. So you're having to pay back more, and so each year, some of that amount is interest. Great question. And I think that you'll see how interest plays into this as we continue to use cash flow diagrams moving forward. By the way, one thing I wanted to point out is don't let it throw you off when occasionally maybe the numbering is slightly different, because in some cases I solved these in-class exercises in a previous semester when I had them grouped together a little bit differently. So, you know, if you printed out today's in-class exercise, then this will have been problem 3 that we were just looking at, but on my key it shows problem 1. Don't let that trouble you. It's the solution of the problem that I'm hoping to illustrate here. All right, so now what about this other statement where it was saying you save $10,000 at the end of each year for 6, and then the 7th year you withdraw the balance, which we don't know what it's going to be because it doesn't say in the problem statement what is the interest rate. So we can't calculate how much there will be in the account for us to withdraw. But from the bank's perspective, now this is flipping it entirely. If we say do it from the bank's perspective, because from the bank's perspective, what's happening is that that you are going to be giving them $10,000 for each year for 6 years, and then they have to pay it out. So from their perspective, this is what you are doing. This is your perspective. So the bank's perspective is the opposite of that. So let me zoom out a little bit so we can see both at the same time. There we go. All right. So here are the two perspectives of this transaction. Your perspective is that you're paying 6 payments of $10,000 and then you withdraw, meaning that you get the money. But the bank is receiving 6 payments of $10,000 and then paying out. So the arrows are down. All right. It's a minute over the end of our class period time. So I have taken a loan out from you. You've loaned me 1 extra minute, and I'm going to pay it back to you with interest in Friday. I'll let you out a little bit early. I apologize for going over. I'll attempt not to do that in the future. I like to really be respectful of your time. But before we part ways, let's just review these announcements one last time, that what you're going to be doing is completing the introductory Teams call, and then homework 1 is available now if you want to take a look at that and start figuring out those problems. It's available for you to work on. Thanks for being here. Hope you're doing well, and we'll get together on Friday morning. Take care.
Dr. Waite?
Yeah, go ahead.